Mike, can we just start with this mess playing out in crypto all around us with things like FTX? What does it mean to you, Mike, looking at the broader equity market?
Yeah, I mean, look, this is financial contagion risk. I think part of the reason we rallied so much yesterday, quite frankly, is because I think there was people putting crash protection on into what was, an event that had been obviously previewed for several weeks. I mean, the CPI release was the event. It was actually the fourth event in 2 weeks that we've been focused on, that we've been kind of waiting for to finally get this rally in bonds, John, that we've been talking about, it seems like, for months. And the four events were the Fed itself last week, which remained hawkish, but kind of opened the door to a step down in terms of rate hikes, pace of rate hikes. And then, of course, we had the strong non-farm payroll number. Then we had the election, which I think will lead to a mixed government at the congressional level. Maybe not a red wave, but enough to block crazy fiscal next year. And then we got the CPI, which really confirmed a view we've had for a while, as you know, which is that inflation has peaked and it's probably going to come down pretty quickly. So all that leads up to what we think was the fattest pitch in the market, which was going long duration. And that will lead to the next leg of the equity rally, because as rates come down, what I think will happen is, and we saw this yesterday, so it's good confirmation, the Nasdaq, which has been the laggard in this rally so far, can now catch up. And that's what happened yesterday. I mean, obviously the whole market was up, but it was led by, these longer duration growth assets, and that's tied directly to the move in rate. So that's basically our call to a T. The tricky part now is going to figure out, okay, when is it over? I don't think it's over yet. I mean, clearly this overhang from crypto is not constructive, but I think what it did yesterday, I mean, we saw a big retail selling yesterday. So it's amazing to me is that we're having this event, which is a little bit scary, and yet the market was up, 6, 7, 8%, depending on which one you're looking at, which tells me that people were just out of position. So probably further to go, I would say, through Thanksgiving, maybe even into early December. We'll, us, John, we'll manage this tightly. We'll be disciplined, but I don't think the rally's over at this point.
Mike, have you had a rethink of the range, the initial range that you introduced for this bear market rally?
Yeah, so 4,000 to 4,150 was the range we targeted on the S&P 500. As I mentioned earlier, the Dow Jones and the small cap index actually already exceeded its 200-day moving average pretty substantially in the case of the Dow. So as the Nasdaq maybe gets towards its 200-day, we could actually see the S&P maybe go through its 200-day to the upside. I mean, I don't know. I mean, it's hard to be that precise, because we do think this ultimately is a bear market rally. But once we get through the 200-day, that'll probably get the animal spirits going even more. That'll draw in more, kind of passive flows that track that type of data. And we could see an overshoot, I mean, I wouldn't rule it out. Something like 4,200, 4,300. We'll just have to wait and see how it goes, John. It's going to remain volatile. This is not the kind of market that the average person should be trying to trade. This is a trading call. It could be very profitable if you cut it right. But it's still a bear market, so it can rip you apart.